Talk of the tape, the big pivot, investors shifting their focus away from inflation panic to growth fears. And the market is navigating it reasonably well, certainly at least today. Stocks posting gains on the day, but our next guest isn't calling it all clear from the recent sell-off just yet. Joining me here at Post 9 is Avery Sheffield, co-founder and CIO of VantageRock at Rockefeller Capital Management. Avery, good to see you.
Good to see you too.
Bye. We've known for all year the market's been kind of fighting a two-front war. Inflation on one side, wobbly growth on the other. It seems like slower growth maybe today seems like the solution for the inflation problem on some level. But how would you read it? Where do you think the pendulum swings next?
Yes, well, I think it is possible that we have seen peak inflation. With commodities coming off, energy, but not just energy, the metal stocks. Also, you have the food-related commodities coming off. That's likely to be positive for the rest of the economy. You also have seen in trucking and supply chain some loosening. Many companies are still under contracts, but some signs of inflation to abate next year. But so I think that's why rates have come down a bit, and that's net positive versus where we were, a few weeks ago, certainly a month ago. The question here is, really, is how much inflation would potentially moderate, and does that still leave us with a higher discount rate than we've had before, and a little bit more pressure on the economy than maybe we've had in the past?
And we have this sort of timing issue that becomes a little bit awkward or uncertain, in which if the market's gaining confidence that it's in peak inflation, the Fed's not taking that for granted.
Yes.
So the Fed will keep trying to lift rates pretty aggressively. Powell said as much today. And then in the meantime, we don't know exactly how much of a growth sacrifice we're going to have to experience. So
yes.
how does that translate into what you would want to be doing with your portfolio?
Right, certainly. Well, there's like a short-term navigate through, and then there's what you think will happen longer term. So short-term, look, we're seeing a rally, of a growth-driven rally, a rally of names that are considered to be more stable, but also a lot of names that have been growthy, but actually still don't have good business models. So those types of names, like they might work for a while, but I would still be very cautious on some names that have run a lot today and recently because they just don't have underlying strong fundamentals. However, at the same however, on the long side, what is beneficial is, again, if interest rates have peaked. I don't know that they're peaked, but if they're coming down a bit, if inflation's a little bit better, we have much lower valuations in a lot of more cyclical companies that are actually really cheap on even 2019 earnings. They're pricing in, I think, a recession, maybe not a dramatic recession, but enough of a recession that we're kind of incrementally more positive in those areas.
Do you think that we're in this mode where it looks like they're getting cheap enough, but there's going to be time? I just wonder about the motivation for having any buying urgency to play those themes.
Absolutely. Look, and I think, they say that the hardest thing for a bull in a bull market is like not to be buying, and the hardest thing for a bear in a bear market is not to be buying. And right. I'm probably more in that bear camp of like they think they look cheap. What's going to happen to the earnings? So I think, look, you certainly could be too early in buying stocks, but I would recommend to investors start at least looking at these types of names. We run long and short, so we have the ability to, if we get the timing off, but we pair well enough, we can navigate through. But I would say also, while it might be early, and so I'd caution someone, to dive in too much. You do have companies out there that we think are still also misunderstood about how they might navigate through a recession, and that's more interesting to us on the long side. I would also say something that I think is something that really is not well or understood, or we think about, or we've been thinking about a lot, is we think the economy has had a meaningful influence from stocks that are, we would call, growth at an unreasonable price over the past 5 to 10 years. Yeah. And these companies have grown just driving revenue without profitability. That has been a deflationary force in the economy that we think is underappreciated. Many of those stocks have come down. They might be rallying today, but many of the stocks have come down, and those management teams are starting to think about profitability. If that continues, they are likely to be raising prices and cutting costs. And that, on the flip side, helps the companies that they've been trying to displace with deflationary pricing to do better moving forward. And so those types of companies that are incumbents that have maybe been disrupted by really deflationary, can you say, irrational competitors, we think are, potentially more interesting.